stocks, crypto, credit moves. Good afternoon, YouTube. I'm back again for another video. In this video, I will cover a question asked by a subscriber. Uh, which one is better, ETFs or stocks? And we're referring to the stock market, of course. Um, to answer that question, it just depends on what kind of investor you are. Are you an investor that's going to freak out if you open up your account one day and you see your portfolio down 50%? Um, it's just going to depend on what kind of risk you're willing to take. So ETFs and stocks are good. I like both. Of course, the benefit in an ETF is going to be that it's not a singular position. So some ETFs actually have over 100 different stocks that are being held in that particular fund to lower risk. One downside to ETFs will be that they do have fees that are charged, and they because they're professionally managed. So let's pull up an ETF that I like. Uh, make a couple examples and let's pull up Drive. All right, so this pretty much gives information. Inception date is when this fund was created. The expense ratio. Um, so that's going to be, in my opinion, the biggest difference between an ETF and a singular position. It's going to be you're gonna get charged an expense ratio, and let's see if they give us a. So it says here reflects the total annual expense associated with ownership of the fund, included but not limited to management fees and acquire fund fees and expenses. Refer to funds full summary. So it seems like with this particular fund, there may be additional fees besides the expense fee. So, guys, when you're picking ETFs, that's definitely the first thing that I would check out. Just check and see exactly how much money you're being charged to actually be a part of that fund, because you really can put together your own ETF just by, let's say, like if you like Drive, you can actually go and scroll down and look at the top 10 holdings. And you actually can legitimately make your own ETF if you wanted to. But ETFs have value. Um, they usually are not gonna your returns, in my opinion, are usually not as high because the fund is spread it in so many different stocks. So look at this one. You have Google, Apple, Intel, Toyota. So they have some very good companies in this stock. Tesla, Microsoft. But look at all these other companies that some of them I'm aware of, but other people may not even know. When you buy into this fund, you're spreading your risk so thin that when one of these companies may have a strong run, the risk is the run is minimized because you spread it so thin. So you have so many different companies in this that it just limits your upside. So that will be a downside of an ETF. Let's look at since inception. The return is not bad. So we got a 22.65% return over the exception. So that's about 4 years. And last year was 27.98 and the market was 27.8. So this fund has performed well over the last few years, also too because of the coronavirus. So some of these numbers are a lot higher than probably what they normally would, because back in 2020, anybody can make money if you just bought a stock around the time that the coronavirus actually started and just held to the end of that year, and you would have made a ton of money. So that's not really a true indication, in my opinion, of the stock market. Last month is up 0.47. The last 3 months is up 11.5, and since inception, 113%. So I like this. I like Drive. If I were to actually invest in the ETF, I would definitely consider this one a pretty good one because it's spread it around. It has very good companies. Um, my only my only thing that I don't like, I wish that the net asset percentages wasn't so spread so thin like this. So even if Google was like 9% or Apple was like 9%, I would like this fund even more. So that was my opinion on the ETF, and they're going to all be set up similar. So let's look at a singular position that has done well over the last few years. Let's check. Let's check. As a matter of fact, let's do Nvidia. Let's look how well she's done over the last year. So we have a 52-week low of 122 and a 52-week high of 346. Let's see here. They have a target on it for 341 after a year. So I'm trying to find the return this year. We can just look at this 52-week range here, YouTube. So we got a 122, and now it's 229. So that's almost 100% return from the low a year ago. So you compare that to Drive, which was 27%, and you compare the singular position of Nvidia. Low was 122 within the last year, and not right now it's at 229. So that's a 75% different return. And that's the part in me where I prefer singular positions long term over ETFs because your upside is not limited. So that's a 75% return over a year compared to Drive's 27. The 27% is still outstanding. I just want YouTube to understand that you're just limiting your upside with ETFs. With singular positions, they also go against you just as well as when they go in your favor. So when they fall, they're going to fall harder than the ETF. So you just have to figure out what kind of investor are you. Are you somebody that's going to be very uncomfortable to wake up and see your portfolio down 40 or 50% in the short term? Then you may want to stay away from singular positions because you actually can find ETF that has this stock Nvidia in it. Or if you kind of like the investor like me, if you're thinking more of a long-term strategy, you'll buy singular positions and you just hold and you can buy the dips. And if you don't want to buy the dips, you just wait for those stocks to recover and you're profitable. So both have value. So I don't want to continue to ramble on. Just want to cover this topic. I would love to have you as a subscriber. Like, share, comment. And until next time, signing off.